You're watching a replay from the 49th Annual Gabelli Automotive Symposium, recorded live via Zoom in Las Vegas. This presentation is shared as originally broadcast. Minor technical interruptions may be present due to the live recording format. Thank you for tuning in.
And what is an annual privilege that we get? The Motor Equipment Manufacturers Association and the Automotive Aftermarket Suppliers Association come together and present to us and with us for approximately an hour every year, and to learn about all things automotive aftermarket, where the market is, where it's going, and there's certainly no dearth of information. I've had the privilege of knowing Bill Long for over a decade now, and this is I'm sad to say Bill's last time presenting with us. Bill's maybe it may not be the last time here. Bill's the president and CEO of MEMA, and Paul McCarthy is the president of the Aftermarket Suppliers here, and they just give a tremendous amount of knowledge to us. So I'll give the floor to Bill and to Paul. But we'll have more to say towards the end. But Bill, thank you.
Thank you. I won't make it to number 50 for your, I'm sorry, 49th annual symposium might indeed be my last. Rumors, just. Well, on that note, I just wanted to say thank you for the opportunity. The last 13 years, Paul and I have had the opportunity to share an overview of what the automotive aftermarket looks like, certainly from a supplier standpoint. And I announced in March my retirement from MEMA, and I'm proud to point to Paul McCarthy as the good news, because Paul will have the keys to the kingdom to lead MEMA to another whole new level. So congratulations to Paul. So if you're not familiar with who we are, and this might be your first conference, we're the trade association that represents the largest sector of manufacturing jobs in the US. Some 930 direct jobs. No other component or manufactured item in the US employs more people than those companies that make parts and systems for the automotive industry. We're celebrating our 121st anniversary this year, and contrary to popular belief, I was not there at the very first meeting. We represent 2.5% of US GDP, and as you can see, suppliers, as many of you know, are located in all 50 states. The combination of all those gives MEMA a very strong voice at the seat of where policy decisions are made. You might also know that vehicle suppliers contribute about 2/3 of the value of a new vehicle on average. And as many of you in the room know, a lot of OE tier 1 suppliers are also aftermarket, very heavy participants. And of course, the aftermarket suppliers are the ones that keep the life cycle of the vehicle continuing and growing, which we all love. And by the way, welcome to Apex. We are a co-owner of Apex, and we have a great show this year. You'll find a lot of new things and profiling all the new technologies and new products that aftermarket suppliers are going to bring to the industry. I know with Mr. Jaffe talking about growth opportunities, you'll see a lot more of that at Apex the next couple of days. We exist for just a couple of reasons: to foster a growing, profitable, innovative, and profitable automotive sector and community. And we wake up every morning with the goal to advance the business interests of the supplier community. So that's what Paul and I do. Last year, when we stood here, we said we were going to see an unprecedented level of uncertainty. And I think we've taken the term uncertainty to a whole new level, and we'll talk about that a little bit more. We talked last year about the shift to new technology, the race to EVs and innovation electronics, autonomy, supply chain disruptions, which we predicted would continue. We also talked about how suppliers were going to then navigate with the new administration in the wake of the view of sustainability and ESG. Certainly workforce issues, the available workforce, particularly the challenges now of reshoring, the pressures on suppliers to reshore products and manufacturing back to the US in the wake of workforce challenges. And then maybe a more global, holistic challenge, the need for US manufacturing competitiveness globally. And we've been championing that discussion on Capitol Hill. There's two ways to erase a trade deficit. One is to buy less, and the other one is to sell more globally. And we all know, probably in this room, that reshoring doesn't necessarily achieve global manufacturing competitiveness. And certainly the regulatory landscape is on the top of everybody's radar. We also did a little quiz last year talking about who is going to win the election. It's hard to believe that President Trump has only been in office for the short period of time that he has. But what we said at this conference last year, EVs are here to stay, albeit at a slower rate, and that's proven to be true. The challenge for the industry and the supplier community is now trying to balance the manufacturing of ICE components as well as EVs, and particularly the parts proliferation challenge that comes to the industry and the headwinds to the aftermarket. We also identified at that time that the China-Mexico tariffs will impact cost. And as we get into the conversation about USMCA a little bit later, some of those challenges. And then certainly lower new vehicle sales, I've got a chart that'll touch on that briefly, will impact the aftermarket down the road. And we'll talk about that blip briefly. So the current realities, I won't spend a lot of time on this, but the chart tells the story that tariffs have continued to hit the supplier community and the automotive industry as a whole. We've kind of been right at the epicenter, and the target of those started in February, and it seems like every month the industry has continued to try to navigate the challenges that has presented. I think this is the tale of the tape. Customs and Border Protection has collected $475 billion as of August 24th from IEEPA tariffs, reciprocal tariffs, the stacking. This also includes steel and aluminum and derivatives. So a pretty hefty burden on the industry. And according to the Center for Automotive Research, CAR, they've predicted an increase in the average price of a new vehicle just from the components, not imported tariffs for complete automobiles, but just the parts will add about $3,500 for the first year, and so on up to $4,600 over the next 3 years, to what is already an inflated average high cost for a new vehicle. In aftermarket terms, this bodes well for maintaining the vehicle that you have and the continued growth in the average age of the vehicle, which is nearly approaching 13 years, I believe. So, oops. Again, here's the trough that I mentioned briefly. I just put this up to show that in 2016, we had the highest level of annual vehicle production at 17.8 million. And 2020 through 2022, we've seen that dip. We're continuing to edge back up, but those years are now flowing into the prime replacement rates, age of vehicle, 8 to 10 years of age. And we'll see a little bit of dip in the available market for those vehicles. And finally, USMCA. We have been very active in providing comments. There's a public hearing, which we are testifying at on November 17th. USMCA, in the view of our members, is critical, the top #1 issue for regulatory policy to maintain the USMCA agreement that's in place. The challenges for part of the discussion, many of you are familiar with this, we're going to be facing conversations about a higher regional value content requirement, restrictions on Chinese manufacturing in Mexico and how that'll affect USMCA, the movement of parts from a lower core or regional value content to a higher one. So if you're in that category of technology parts and so forth, the labor value content, sure, that's OEM related, but that falls back on suppliers as OEMs try to improve their labor value content. Steel and aluminum, of course, is a threshold, and certainly how USMCA will impact the existing tariffs of 232 and IEEPA and so forth. So Paul is going to share all the good news with this backdrop about the strong foundational pillars for the automotive aftermarket and the reasons why we are somewhat bullish on the future and as we built on last year. So Paul?
Thank you, Bill. All right, as Bill mentioned, since we are here at Apex, we'll walk through the outlook for the automotive aftermarket. Now, we are proud to have been representing the aftermarket and its suppliers for 121 years, believe it or not. And our members supply vehicles from cradle to grave. So from its birth on the assembly line, and then in MEMA aftermarket suppliers, we represent suppliers to the revenue lifetime of the vehicle. So our members are the folks who make the parts, the tools, the chemicals, the diagnostics, all the technologies that keep vehicles running safely and reliably across their lifetime. And our members supply to automotive and commercial vehicles with new and remanufactured solutions. So as we go through the outlook, we're going to start with the current conditions, which all things considered are pretty darn good. If you would have told us in February or March that we'd ride this roller coaster and end up here in terms of market conditions, I think we'd be pretty happy. We'll talk about some of the structural drivers behind that, as well as some of the things, the risks to keep an eye on, and how we think technology is bringing a bright future for the aftermarket. So starting with the current outlook, there's clearly turmoil in all kinds of different dimensions. But throughout that, the aftermarket has been amazingly resilient, even by the high resilience standards that the aftermarket has. We've certainly been impacted by tariffs, like every industry. Our pain points include costs, certainly, uncertainty, as well as just the time and costs of tariff analysis and compliance. That seems like that's one of the biggest growth sectors in the US, I think, right now. So even for us suppliers, the folks directly impacted by the tariffs, we've gone from the beginning of the year, where frankly, we were in a bit of a state of panic. And as the year has gone down, increasing positivity about the outlook for the marketplace. And this comes from our quarterly supplier barometer, which also showed last quarter quite positive sales results for the majority of aftermarket suppliers. And if you look at our customers, frankly, they've done very well. So this chart looks at same-store sales quarterly from the big four public retailers and distributors in the aftermarket. You look at how they performed post-tariff, they've been trending up. They're all in positive territory now, and some of the performance has been excellent. So clearly the aftermarket has held up impressively well despite the tariff disruption. Part of that is because parts inflation is back. And we like that in our sector. As long as it's at reasonable levels, we do have that price inelasticity for some of our key sectors. And so again, if it's price is at a sustainable level, we like that inflation. It's good for our top line growth. That's what we've experienced this year. And frankly, the investment community has largely liked what you've seen. Our performance has been fairly strong throughout most of this year. So pretty solid performance, at least if you take a step back. Let's look at the fundamental structural drivers behind that marketplace. And previewing things a little bit, I want to point out how the performance we're seeing is more than just tariff-related inflation. So one of the factors, maybe our super cycle driver, is the incredibly high price of new vehicles. It's at extraordinary levels for most Americans. And Bill mentioned it with some of the inflationary prospects. To date, the automakers have largely absorbed the cost of tariffs, but we know that over time, tariffs is going to have an inflationary effect there, which just leaves consumers more reliant on the aftermarket. If you look at our big three sort of structural drivers in the aftermarket, the first is average vehicle age. It's at a record, almost 13 years, as Bill mentioned, and it continues to grow. It's also kind of amazing to take a step back because over the last 20 years, that age has increased by almost a third, and it's continuing up. Vehicles in operation. So that's our fundamental addressable market. That has also been growing. By the end of the decade, we expect to exceed 300 million vehicles in operation. And there's an increasing number of analysts who look at that and say there may actually be some pent-up demand, some upward pressure on these types of figures. We'll talk more about that. And then miles driven, they are also growing and look positive. We recovered well from the pandemic, and we're back to sort of historic growth levels. So our big three market drivers, vehicle age, VIO, miles driven, they are green. And that's a nice structural position to be in, even outside inflation. Looking a little more tactically, I'll just throw out one. It's near term. It's kind of an interesting one. The de minimis loophole and its elimination. We know there were billions and billions of dollars of auto parts that were coming into this country, tariff-free, using that loophole. And there is a question, maybe a theory, that with that elimination, that could shift more sales towards more conventional channels, which many of the folks in this room invest in. We will see. What we do know is that trade enforcement is something that we need to see at a number of levels to ensure that we have a level playing field in the marketplace. I will say the administration has been pretty assertive on this, and we think that retailers and distributors also need to, given the reputational risk that they face on this front. One of our big trends that we probably don't talk about enough is the market shift towards light trucks. So these are SUVs, crossovers, pickup trucks. It's been happening for a while, but it's now over 80% of new vehicles sold are these vehicles. And if you think about those vehicles, they tend to be a little bit bigger, a little bit more capable, a little bit heavier. And that leads to parts that are often a little bigger, a little more capable, a little bit more expensive. And we think that that's one of the reasons that our industry has arguably performed a little bit above trend this decade, is because of this trend, which still has tailwinds as it makes its way through into the vehicle park. So our focus today has been on the automotive side, since we're here at Apex, but our members also supply to commercial vehicle aftermarket. I think you have some speakers from that. So we thought we'd go very quickly through a couple of their fundamental drivers. Commercial vehicles in operation also have been growing, almost 10 million commercial vehicles in operation in the US. By the way, our definition of a commercial vehicle, class 4 through 8 vehicles, so GVWR 14,000 pounds or above. The growth that we've seen has been in class 8, which are the largest, heaviest vehicles, the best ones to find economics in, and then also growth in class 5 commercial vehicles, and that was driven by last mile delivery. Commercial vehicle average age also continues to increase, and it's even higher than what you see on the passenger car side, almost 16 years old on average. So these fundamentals, plus other factors, have led our partners at McKay & Company to forecast, as you see, pretty nice, steady, expected commercial vehicle aftermarket growth. And that means the commercial vehicle aftermarket, it's really been a pretty rare bright spot in the trucking sector of late. Now, speaking of adjacent markets, while we're here, we should also mention the specialty equipment market. So these are the appearance, the performance things that you'd see over on the SEMA side of Industry Week. So very fun things, but a much smaller market in dollar terms. But our friends at SEMA are projecting that we'll return to a little bit better growth in upcoming years after the last few years, which have been growing, but flattish growth due to the general pressure that many sectors have seen on discretionary spending. And that, of course, comes on top of what had been very good growth during the pandemic. So going back to that automotive lens, is it maybe any wonder that John Murphy had calculated that the vast majority of the profits in our industry are in the bottom half of that chart, in the lifetime of the vehicle versus in selling new cars. And the aftermarket, which is that orange slice in the bottom right profit piece, the big piece of the profit pool. So very resilient aftermarket is what we're seeing, but there are certainly risks, things to keep an eye on, or at least things that have led to some concerns or questions from investors. So let's start with the elephant in the room. And we think we found the smoking gun, the origin of First Brand's problems, extra Christmas profits. Obviously that's a joke, but believe it or not, this is a genuine vintage Trico ad. And even that creepy guy is not a product of AI. But more seriously, we do think both our point of view and I think the aftermarket's point of view is that the First Brand's drama is really much more of a financial story or a private credit story than it is an aftermarket story. Because if you play the preschool game, which one doesn't belong? For the last few years, it was clearly First Brand's. If you ask customers, if you ask competitors, and so you really cannot extrapolate from First Brand's to any other aftermarket supplier. So I know this was certainly a surprise, maybe to the financial community, certainly to the media. But in the aftermarket, we weren't sure what was going to happen, but we've been waiting for the shoe to drop for several years now. You can certainly debate the extended reverse factored payment terms in our industry and whether other models or more normal payment terms might lead to better inventory discipline over the long term. But First Brand's is clearly an exception. And it is not a sign in any way that we can find, Selwyn mentioned it earlier, of systemic issues in the aftermarket. And by the way, from everything I have heard, if you strip away all the financial stuff Patrick did, those underlying core brands at First Brand's, they are cash flow positive. There are some valuable assets that a lot of people in the industry are interested in. So in terms of other issues, I'd say actually one of the top ones from a supplier perspective is just the cost, not so much the cost, maybe the time and energy that tariffs have taken up, certainly the opportunity cost. So from our perspective, it's been frustrating the amount of energy and time we put into that when we want to be putting our foot on the gas on all the supplier innovation, the technology innovation that we know grows the aftermarket. So as you walk around Apex, if you get a chance to do that, you'll see lots of innovations, products innovation, marketing innovation, technology innovation, but there's a lot more to come. The biggest complaint from suppliers is I got all these great ideas, and I just don't have the bandwidth right now. So as tariffs settle down, hopefully we will see that even more in the industry. Another thing that sometimes gets mentioned is shop consolidation, because we've seen some private equity come in and look to do in the mechanical sector what we've seen happen in the much smaller collision sector and consolidate this. It's certainly a change agent. I'm not sure it's seen by many in the industry as a threat. And the reason for that is first, this remains a large and incredibly fragmented market. Secondly, this is something we've been expecting for a very long time. Given the consolidation we've seen in other steps of the value chain, this was inevitable. It's also can be a good thing in the sense of having shops that are in a position to invest for the new and higher technology vehicles is positive for future growth. And then I think finally, the thing is frankly, consolidated shops had better have some wise purchasing, because if you buy crap in scale, you're gonna have a lot of comebacks. You're gonna have a lot of unhappy customers and a lot of financial pain. So certainly have to have some smart quality buying. Bill mentioned earlier this issue that we had several years of lower new car sales, and that will eventually make its way into the aftermarket sweet spot. That's a concern. I don't think it's really keeping anybody in the aftermarket up at night for a few reasons. First, the sweet spot in the aftermarket has broadened over time. We found a lot of ways to make money on old and ever older vehicles. Second, we performed fairly solidly coming out of what was a much bigger dip coming out of the Great Recession. And then finally, new vehicle sales are projected to return to more normalized level, refilling that pipeline. And as so often in the aftermarket, there's a silver lining. That silver lining being that the share of vehicles in warranty is shrinking, which means that the addressable market for the independent aftermarket is expanding. For example, when we project forward in 2035, that the single largest vehicle age category in the US will be vehicles over 20 years old. And we're holding on to those vehicles because we need them for our lifestyle and to keep things going. And this has led to some analysts we speak to increasingly developing a theory that there is some pent-up demand in the number of vehicles. That one of the reasons we've seen these elevated used car prices is because we're on our way to soon surpass 300 million vehicles in the US, but perhaps the natural level of current demand is more like 310 or 315. And that's part of these dynamics and why we just hold on to these vehicles as long as we can. One sector of the aftermarket that has struggled is collision, where we've seen a big increase in prices, and that led to an increasing write-off of vehicle collisions, partly due to some of the AASA technology increasing the cost of collision repairs. Also led to some interesting actions as people try to get a hold of some of these valuable components. The solution to this is frankly the same it has been for a century, which is a good dose of aftermarket competition. And just the way the market's structured, there is fundamentally less of that competition in collision than there is in the mechanical side of the aftermarket. But we all know what competition brings. If you have competition over time, you'll get better prices, more cost competitive. And in addition, in the aftermarket, what we see with competition is we also see an increase in repairability as people figure out how to repair these vehicles. And so that need for competition is just another reminder of something we do need and advocate for in the industry, which is passing the Repair Act and making sure we continue to protect property rights and the market competition in repair. This is a rising tide that lifts all boats from new vehicles all the way through the lifetime of the vehicle. So all of these different issues raised, I think the biggest concern probably in the industry are the things outside our control, the general economy. So we all know that consumers are not feeling great. Employment growth, that's always a nice driver for us, still positive, but it has certainly been decreasing. It is worth remembering that if we actually get into a recession, not that people are talking about, but if and when it happens, the aftermarket again is incredibly resilient. Yes, we are weakly cyclical. Some elements feel the cycle, but we are much less cyclical than what you see on the new vehicle side, which you see depicted here, or almost every other consumer good. So that leads to what may be the biggest concern in the industry, which is some of the pressure on lower income consumers, which has been getting so many headlines. And maybe this explains some of the differential we're seeing in DIFM versus DIY performance of late. And it's true, just like so many other goods, the cost of vehicle repairs to the end consumer has gone up fairly significantly. And this has led to chatter, a little in the industry, I think more in the investor community, about whether these issues on consumer spending power could lead to deferred maintenance or trading down. You know, for example, Selwyn mentioned it, could you postpone your oil change by a couple of months? Or I need a brake job. Could I just replace the front brakes instead of all four brakes? Or could I just do the brake pads instead of the pads and the rotors? But again, the silver lining for the aftermarket is we found over decades that deferred maintenance really just means deferred revenue for our industry. Because if you don't take care of your vehicle, it just means a more expensive repair down the road. Another reason we think consumers have been fairly willing to spend on repairing their vehicles is that gas prices are relatively affordable versus income. And we only raise this one because for some categories, gas prices can play an outsized effect because it's something that is so visible. We see it on signs next to the highway. We pay it every week. That if gas is seen as expensive, it can be an issue. Currently, it feels not too expensive. And so people are more comfortable, we think. I think that contributes to people feeling comfortable investing in other parts of their vehicle, namely repair. This is tactical, but tax refunds and some of the other stimulus, these things tend to be nice boosts for us. And the projections are that tax refunds are looking very positive next year. And what Bill had mentioned, used car prices, they've come down. They are still very high. So for most folks who need a vehicle, it's not really an alternative to say, I'll postpone that repair because I'll get a new vehicle in 3 months or 6 months. We have little alternative for most American consumers than to fix what they have and to invest in the vehicle we have. And this speaks to a larger aftermarket phenomenon that for most Americans, there really is no substitute good. That the American way of life for most Americans, our employment, it is all reliant on having a vehicle that works. And if that's the case, the independent aftermarket is typically the best, or certainly the most convenient and most affordable way to get me that vehicle that I need. It's how Americans get to work. So we have a job, we need a vehicle. So how over 93% of Americans get to work using a vehicle. And yes, I've lived in New York. The rest of America does not look like Manhattan. And there's really not an alternative good to the independent aftermarket because that's where 80% of the capacity sits. And the dealer side, they've seen increasing waits for appointments. It's over 5 days on average at dealers. And most Americans, when we need our vehicle, I need to go pick up my kids. I need to get to work. I need my vehicle now. Waiting 5 days for just an appointment, let alone a fix, is not a realistic option. And that leads to what in many ways is the aftermarket superpower, that many of our product categories do have that inelasticity of demand, that within reason, we can take some of that price because we need our vehicles. And I need it repaired now. I think all of that is to say that there is a foundation under some of the market performance that we have been seeing. So now let's shift our view a little bit to the longer term view, the future, because I do think, or we do think, that the aftermarket has a brighter future than maybe some fully recognize. Let's look at case technologies. For example, ADAS, driver assist systems. So this is everything from parking sensors to adaptive cruise control to blind spot monitoring. Consumers actually like that. And we just completed our second landmark study on the ADAS aftermarket ecosystem. And this is a market that, frankly, we didn't even have 10 years ago. That study projects that by 2035, the replacement parts market for ADAS components will be about a $1.7 billion market. We're also seeing a 10% annual CAGR of aftermarket calibrations of ADAS systems. So we'll be doing over 5 million of those calibrations in the aftermarket by 2035. We also have a turning point in our future, which is this market, as you can imagine, began largely as a collision market. You know, I got a fender bender, I got to replace the sensor or the radar that was in my bumper. Over time, as the vehicles with this technology have aged, we've seen an increasing mechanical repair market. And in 2031, we actually have a turning point where the mechanical side is a larger market than the collision side for ADAS. So what does it look like when we get full automation? Believe it or not, our industry sees it as an opportunity. Because if you think about the goal of vehicle automation, it's to make a good more convenient, more available, easier to use. All of that is about increasing usage. That's a wonderful outlook for us. We've already seen Waymo reach out to our aftermarket trainers to try to help them train their technicians, get technicians, help them keep these vehicles on the road. And if you think about a future of automated fleets where uptime is paramount, that is a wonderful maintenance and repair situation. And the data has shown pretty unequivocally that shared mobility broadly has led every place it's been introduced to significant increase in miles driven, and even, interestingly, vehicle ownership. So again, you take any good, you make it more convenient, more available, easier to use, you will likely increase the usage. And that is what the data tells us automation and shared mobility do over time. And anything that increases usage and miles driven is good for the aftermarket. Let's look at connectivity. This is a technology that's probably the real world rollout has been a little bit slower than initial projections. But as we do our landmark studies for our members, trying to help them see that road ahead, study after study have come back and said, hey, if we look at when we eventually get to a mature, connected world, we're talking about a world of more efficient supply chains, more convenient vehicle repair, and more satisfied customers. All of those are good for growth. And AI, this is an interesting one because I'm not sure we would have thought of this in the industry a few years ago, but the aftermarket's turned out to be a nice little sector for some very pragmatic applications of AI. And it makes sense when you think about our value levers, because it is things like supply chain management, inventory management, marketing, great use of AI, forecasting, engineering, reverse engineering. So we're seeing real opportunities to innovate, reduce costs by employing this technology. Maybe no moonshots, but good, steady progress. Another thing that needs to be mentioned is EVs. Always comes up as a question here at the Gabelli conference. I do think we all know the forecasters are talking about slower EV adoption versus maybe what we saw in the past. We think one of the good measures of the underlying demand for EVs is looking at retention values. And there you see EVs, which is the green line. Those residual values continue to decrease. And by the time you look at 3-year-old EVs, they are retaining half the value of an equivalent hybrid. So we do a joint industry EV forecast every year, and we unveil it at Apex. And the latest version, it's interesting to look at. Its projection of 2035 EV penetration in just 1 year has been cut in half. And speaking to a number of forecasters, they say, actually, over time, we might see these numbers come down even further because there is an anchoring effect in forecasters. And as we get our heads around some of these market shifts that we're seeing. By the way, one of their big winners you see there are hybrids. We love hybrids in the aftermarket. 2 powertrains, more things to break? Yes, please. Not sure quite what happened to my slide, but this one came from one of the public retailers. And they're sharing their data that the average repair order for an EV is actually 54% higher than for a conventional vehicle. And so repairing EVs has turned out to be much less scary for the aftermarket than maybe people projected a few years ago. Now, over time, that will level out as technology matures. There is certainly a different maintenance profile, a lower in some case, but only if you take out tires and batteries and cooling systems. But at least for the next couple of decades, the industry looks at EV repair and sees a nice opportunity. So taking this down to the product level, the forecast says that all those areas in red are traditional products. They have a long, fat tail. We know it's a profitable tail, and that tail or that piece of the market continues to grow. In addition, we also have opportunities coming from new technologies. And all of this is happening in what is arguably a potential seismic shift over the long term, which is this regulatory shift. Likely no greenhouse gas emissions on vehicles. The Big Beautiful Bill took away penalties for missing fuel economy regulations. And this could be big over time, because it's literally the first time since the first Richard Nixon administration that regulations are not shaping what vehicles we have to choose to buy, that consumers really can buy whatever vehicle or performance level that they want. And this could, over time, change the VIO. So to get our heads around this, we did 2 things. First, we invited some outside experts to come in and share their point of view. Then we talked about it with our member CEOs who are developing a lot of this technology. And their conclusions aligned, which is it's long-term play, but over the long term, they do believe this will mean more aftermarket growth. That long, big tail we talked about probably becomes longer and bigger. And if you give Americans the choice of pretty much anything, from sodas to cake to cars, we tend to like things a little bigger, a little bit more capable. And higher performing or larger vehicles will mean larger tickets over time. So it is another great example of how threats that come into our marketplace over time, you just give us a little bit of time, allow our entrepreneurial aftermarket spirit to try to solve the problem, they become opportunities. And that is part of the value, the power of selling in to a huge installed base of necessary goods that have a very long life. So a few conclusions to just try to quickly pull this together. We also do a joint industry forecast for our industry. And as you can see, it projects pretty solid, nice growth over the next few years. In fact, it believes that end consumer spending on repair and maintenance in the US will exceed $500 billion by 2028. And that's due to increasing complexity, all the things we've been talking about, increasing vehicle content, cost per part, and increasing fleet of aging vehicles. So our world is very uncertain. There's a tremendous number of challenges that faces every business these days. There will be winners and losers. But one thing we do know is that the American lifestyle and economy are based on the vehicle, and that will continue. And if anything, it's indicating that over the next decade, that dependence will likely increase. So there is that famous saying, often attributed to JP Morgan, go as far as you can see. And when you get there, you'll be able to see farther. And what we think we can see in the aftermarket, there'll be noise in the underlying trend. There'll be some ups and downs, but we can pretty clearly see, based on these drivers, a couple of decades of resilience and growth in the aftermarket. So Gabelli has been having these conferences for almost 50 years. And the discussion at these conferences, at least the ones I've attended for a long time, has always been that the aftermarket is a steady, growing, cash generating, largely attractive industry worth considering investing in. We think we'll be talking a similar story when we're at the 70th Gabelli Aftermarket Symposium, probably the 75th. So thank you for your time. Bill and I very much look forward to your questions.
Hey, Paul, while you're up there, that's the first question. On the barometer slide that shows the accelerating growth from your member base, how much of that is price versus units? And as you think about this year shaping up and sort of growth in the industry, how do you parse those two out? And I guess when you think about price, where are we peaking? Is that at the end of this year? Do we continue to see same SKU price inflation through the first half of next year?
Well, as always, good set of questions. We're honestly not as in tune to some of the very nearest term data as I think maybe some in the street are. But yeah, if you look at the growth, it's certainly been a good chunk of it has been price, but it hasn't just been price in some categories. We do talk about some of those underlying trends that we see. And by the way, that's nothing new. I mean, we've seen declining replacement rates for decades, and that's offset by these higher, not just price, but also just the value and the complexity of these components. In terms of price, thanks in part to some of our advocacy, I think the tariff situation is clearing up a little bit more. Not all of that has gotten into the system, but it probably is less than what some of the noise and uncertainty we've had the last half year. So I think the general industry assumption, the buzz over at Apex, is we still have some price to come, but it's not crazy. And by the way, we like that. We'd rather it be steady, sustainable price than some sort of spike or something like that, because that's better, as you say, for the unit side and the underlying demand. Let's just take, sorry, Mario.
Yeah, just to hitchhike on the same question. If you talked about the inelasticity of price, so if we had a constant volume, constant mix, any number that you want to toss out for the year 2024 and likely 2025? And that's part A of the question. On bread, how much inflation would there be on a constant volume, constant mix? Is it 2%, 3%? What are you hearing?
No.
No, I mean, I think
got it.
I would say the industry buzz would probably be around 2. If we could get a little more, we'd love it, but I think it's around.
And from our point of view, whatever the number is, obviously it adds revenues, but the question is always, do you maintain gross margin? And so that's a different issue that you're not involved with as much as I can remember. So thank you.
That is true.
Bill and Paul, you had a slide up there, I think alluding to the software-defined vehicle and where we thought growth would be. And there's always going to be this pull from the dealer base to try to keep that captive customer longer. And presumably one of the ideas of the software-defined vehicle is that the predictive maintenance aspect of it will allow for that grasp to go beyond the typical 3, 4, 5 years that that a dealer will do majority of the work on some brands. Maybe talk about how you see the aftermarket combating just that increase in complexity and increase in data that's going to be going back to the dealers who are trying to naturally keep that market share.
All right. Well, it's a good question. It raises a whole host of things. First is the data is not always going to the dealer. It's often going to the automaker. Sometimes wants to share it with the dealer, sometimes doesn't. Although, by the way, if we get our Repair Act, the dealer will get what they need for repair. The second thing is that you raised, I think it's just the increasing vehicle complexity and whether we can repair that. That was a big concern, chatter in the industry, I don't know, 8 to 10 years ago. It's much less of a chatter now. I mean, we figured out, just as we have with every other technology thing, that we can actually repair these. And often repairs get easier because you have better information. You have AI-based diagnostics. Some of the times the fixes get easier, and then the part's actually the easy part. The final thing I'd say is it all depends on what sort of market competition we have. We get the Repair Act, it's fair competition. It's interesting to look at the commercial vehicle sector, where the truck makers, they have their telematics systems. There's independent companies that have their telematics systems. And not a surprise, because you're talking about a technology. It's usually the independent companies who are winning in the marketplace, who do a better job of servicing the fleets, a better job of doing this, because they're the agile, entrepreneurial, technology-driven companies. So frankly, if we have fair market competition, the aftermarket is probably going to take more than their fair share of that, because it'll be around innovation. Who satisfies the customer better? And for better or for worse, our members supply both, by the way, dealers and independent aftermarket. But the entrepreneurial side, the innovative side, has more historically been the independent aftermarket. And they always kind of follow, see what works, and sort of adopt it for their dealer body.
And this push and pull on right to repair, where does that stand from a support standpoint, politically?
That one, or?
Well, you've done most of the homework on right to repair, but I would just say that we have a lot of sponsors for the bill in right to repair. It continues to be a battle, of course, with the OEM's interpretation of what right to repair is versus the aftermarket. But we think we are hopeful. And the benchmarks for us is we didn't think we'd get as far as we have with this bill, quite frankly. And we've got bipartisan support. But it's the battle is really trying to clarify all of the fake news about what the potential OEM alternative bill is versus the bill that the aftermarket's introduced. So the challenge that everybody has in the room and with right to repair right now is that the technology that we currently have, most technicians and the industry are able to repair those vehicles. But it's when we get to a greater software-defined platform that the real issues will begin. So until the industry and motorists begin to see and experience that their vehicle can't be repaired at a greater level, then at that point we'll have more legislative support, I'll say. But we're hopeful.
Great answer. And the one thing to clarify is when we talk about the Repair Act, it's not like it's some magic thing. It really just says, let's just keep doing what's worked for consumers for the last 100 years. Let's keep access to repair and continue the status quo of competition, which if the dealer competes better, the dealer will gain the share. Independent competes better, they gain the share.
Great. Brian?
Paul, I think you mentioned earlier in the presentation, USMCA. And I mean, I realize it's very fluid, but I guess the question I want to ask is, from your vantage point, what are the potential outcomes here and how disruptive could this be to the sector in the nearer term?
I'll take a shot at that. The feedback that we get, the conversations that we've had on the Hill and with suppliers, is that the changes for USMCA will probably fall within a manageable level for the supply base. So the rule of origin will increase from 75% to maybe 80, which most of the feedback we get is, is in, an ability to manage. If it gets to 85, that's a little bit different. I think, the other elements are going to also be manageable. So we think the outcomes won't be drastic. The wild card, I think, is whether we have one USMCA agreement or we have an agreement with Mexico and a different agreement with Canada. And I think that's a greater jump ball at the moment. Certainly with the administration's reaction to Canada and the treatment dialogue that's going back and forth between Mexico and the US. So we don't see anything in the agreement at this point that would create a big dent in the industry. So.
Are there any parameters around the timing of all this?
Well, they are, but the rules don't seem to matter. And I say that, somewhat tongue in cheek. The USMCA wasn't supposed to be a renegotiation. It was supposed to be a review. And it has turned into more of a renegotiation. So we do expect to see some changes in the agreement more than a review of the agreement, which was supposed to then just define whether it continues as is or not. It wasn't supposed to necessarily change as it was originally defined.
George.
It's moving fast in the sense that just before this meeting, I was working on finalizing some of our comments that we're submitting to the administration today.
George.
I'm curious, the last 10 years, every year we come back and the average age of the cars has increased. And I read a number recently that about 60% of the cars on the road today are over 9 years old, which suggests that the question being, what is the cap? I mean, is this going to extend a period of time, or is there kind of a point that you see now where people are going to have to make a decision to either buy a new car or trade down to a newer used car? I mean, what's your
Well,
thoughts on
it's
that?
a good question. Our members supply globally. So you go to Mexico, it's average vehicle age of 19 years. You go to other places around the world, it's even older. So yes, vehicles can get older. You get some of the Cuba effect, we jokingly call it. But that becomes another cycle of replacing these vehicles. It all comes down to affordability. And if new car prices dramatically come down, that's the only thing that would lead to a change. And that only happens if we open all the borders to all the Chinese companies who are losing money on every vehicle that they're building. I don't see that happening. And we see it may moderate from the growth levels we've had, but we think we'll be here 10 years from now and vehicle age will be higher than it is now. Almost certainly.
And a big driver of that is certainly the technology in the vehicle and the components or exhaust markets have pretty much evaporated because the technology is so strong. Exhaust systems are lasting a lot longer than they used to, and all the electronics and software and what have you just makes the vehicle last longer. So we're seeing a lot of that.
Unless you cut the catalytic converters out of the bottom of the car and steal it for the palladium.
That's an opportunity.
I thought we'd move to stealing all the charging cords for the copper, but okay.
So with that, this is at least nominally Bill's last appearance at our conference. I think with some pull. Forget it. Bill, we just wanted to express our appreciation and gratitude for you for the past 13 years coming to this event and educating us and being just a great partner from a discussion standpoint. And we have a small token of our appreciation here. Raleigh-Durham is not that cold of a climate, so this vest will serve you well there. But anyway, we wanted to thank you very much for your partnership with us.
Brian Sponheimer is a portfolio manager and Edward Nakamura is a research analyst at Gabelli Funds. This webcast is a recording from the 49th Annual Automotive Symposium, which occurred on November 3rd and November 4th, 2025, in Las Vegas, Nevada. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. As of September 30, 2025, affiliates of Gamco Investors Incorporated beneficially own 24.44% of Stratec, 10.09% of Rush Enterprises Class B and less than 1% of Class A, 6.44% of Standard Motor Products, 4.39% of Monroe, 3.96% of Dana, 1.68% of AutoNation, 1.17% of Advance Auto Parts and less than 1% of all companies mentioned. The analysts' views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the analyst and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the analyst and may differ from those of other Gamco officers, analysts, other employees, or of the firm as a whole. Because the investment personnel at Gamco and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain Gamco personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security nor is it a solicitation of an offer to buy any security. Stocks are subject to market, economic and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. For more information, a prospectus, or summary prospectus, visit our website at www.gabelli.com or call 800 Gabelli 800 422 3554 914 921 5100 fax 914 921 5118 info@gabelli.com